You can toe the line when it comes to investing. Choose the stocks you like one by one, or select Sector SPDR ETFs and add the diversification of an entire sector of the S&P 500, like financial. With liquidity, all-day tradability, and transparency. Ready to add diversification to your equity investments? Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
I'm DeLegge with ETFguide. Welcome to another episode of Marketplace Minute. We're joined today by Brian Kane, an independent financial advisor with LPL Financial in Terre Haute, Indiana. Brian, great to have you with us.
Thank you.
So I want to ask Brian a little bit about your practice and how you build ETF portfolios, and maybe just mention some of the benefits of building a portfolio with an all ETF product.
Absolutely. We use a lot of our ETF products inside managed accounts or advisory accounts. You know, we switched to ETFs about 5 years ago, and probably the main reason was because a lot of the inherent risks that came along with mutual funds, or the inherent problems associated with mutual funds, both being cost, a little bit of style drift, and we felt we could build portfolios using index ETFs more efficiently and still provide the same kind of value for the client. And even a better value for the client than we were using the open-end mutual funds.
You mentioned style drift, and that's probably something our audience has heard about, but maybe you just could explain real quick what style drift is and the kind of damaging effects that it can have on a portfolio.
Yeah. Style drift is a term that we use when open-end mutual fund advisors differentiate from what their stated interest was. Mm-hmm. So if we put a client's money into open-end mutual fund that's supposed to be growth and income, but maybe towards the end of the quarter they're chasing some return and trying to look better, we call it window dressing, trying to look better at the end of the quarter when they report their numbers. They may own some stocks or some bonds inside of that portfolio that don't meet with their stated objective. And they'll do that to try to get some gains at the end. They don't have to report their holdings till the end of that quarter. So within that 3-month time frame, you don't know actually what's inside that mutual fund. So they'll drift away from what it is their stated intention was. And that's a big problem with us because we already own other mutual funds that are in the styles that they're drifting away into. And so now we've duplicated in that client's portfolio, and there's a very specific purpose for why we own the different ones.
Yeah.
So it becomes a big problem in the industry when they drift away from what it is that their stated purpose was to do.
Yeah, it changes the risk dynamics of the portfolio.
Absolutely. Dramatically.
Last thing I want to ask you is about the cost differentiator or cost differences between an ETF portfolio and one built with actively managed funds. Tell us a little bit more about that. I
think we can dramatically reduce the cost to the client overall. You know, you look at your average open-end mutual fund, and you can be anywhere from a 1% maybe to a full 2%, at least 1.5%. And with an ETF portfolio, we can bring those costs all the way down to maybe 0.6 or 0.7%. And over time, you run that out over 20 years, and 1% to 1.5% every year can become a dramatic difference in the overall return to the client.
Great points. Thanks, Brian, for taking the time to be with us. You heard again from Brian Kane with LPL Financial. I'm DeLegge with ETFguide. Thanks for watching another episode of Marketplace Minute.